Hello, everybody. How are we doing? Pretty good. I'm doing great. I'm really tired today, but it is pretty late. But hello, everybody, and welcome to the 15th episode, part 2 of the Lifestyle Business Owner Academy. And this is third week we've gone live. So again, this is your host. My name is Sierra Shugarts, and if you're just joining us, welcome. And if this is your first time joining us, let me tell you what LBO is kind of all about. So here at LBO, we teach people how to build lifestyle businesses, and in fact, it stands for Lifestyle Business Owner. Have you ever wanted to own a business that gives you a great lifestyle? Well, that's what we do here, and that's what we're trying to teach you. Again, we teach ordinary people how they can start from scratch, become a business owner in their community, and then automate the business so the owner doesn't have to work there every day. You don't need any prior business experience or a lot of money. And here at LBO Academy, we empower people to become successful business owners, and we show people how to make the business run without them. If you want to own a profitable business that runs without you, there's a step-by-step play of instructions that you can follow, and this is why we are preaching it. So that's why I'm here today. So be sure to like, comment, or ask any questions throughout the episode, and I'll try with my best ability to answer them. Oh, sorry. Every time I try to wave at people, it just messes it up, but maybe I'll just stop. Okay, so today we're listening to R&B for the holidays. It just warms my heart. Mary J. Blige, that's what I'm listening to right now. I miss her. I miss her a lot. My mom used to always have her CD playing in the car when we were little. So today we're going to go over chapter 11, part 2 of the Lifestyle Business Owner book, titled Improving the Bottom Line with Sound Financial Management. If you don't have time to stay through this whole broadcast, that's totally fine. Go to lboacademy.com and you can join for free today. We have over 100 course videos that will teach you how to start your business from scratch, own the business in your community, grow its profits, and then make it run without you. And that's lboacademy.com. So the new subscriptions that we have right now, if you sign up today, the first 14 days are free. And then after that, you can cancel whenever you want, and you'll be able to get access to all of the videos, all of the behind-the-scenes plays and stuff, and all that good stuff. So make sure to sign up, and you can get your LBO book for free also when you sign up. So, hey, Mom. My mom's on. I like it. All right, so yesterday we left off talking about the 5 best practices when it comes to financial management, and we only went over the first 3. So today we're going to finish off with talking about the 4th and the 5th best practice. So to review, best practice number 1 was to keep meticulous books. Number 2, learn to read financial statements. 3, create a budget every year. And if you want to get yesterday's episode, head over to our YouTube channel or our Facebook page, and those are uploaded up on there. So best practice number 4, we're just going to get right into it today. So proactively monitor the financials. Many businesses or many business owners ask how they can tell whether a number on their financial statement is good or bad. So if they spend over $5,000 on marketing, is that good or bad? That's always a question you need to ask yourself. So lifestyle business owners know that there are 3 ways to tell whether a number is good or bad. So first, you compare it to the budget. If only $3,000 is budgeted for marketing, then you know the actual spending of $5,000 is high. Second, if you compare the number to your company's historical performance, if you spend $5,000 in January of 2017, oh, thanks for the hearts. I love the hearts. They're so fun. And they distract me, but that's fine. It's good distraction. So yeah, so if you spent $5,000 in January of 2017, how much did you spend on marketing in January 2016 and January 2015? So you can also look at it in percentages if that's easier too. So if 5% of your total income was spent on marketing in January of 2017, what percentage of your income was spent on marketing in 2016, 2015? Finally, you can compare financials to the industry averages. So every industry is different, and there are industry-specific reports and consultants who can tell you what the industry averages are. Oh, I thought someone was else on. So yeah, so lifestyle business owners, they monitor their company's performance daily, weekly, monthly, quarterly, and yearly. It's not just something you check once a year. So are avenues trending, or are they trending down? Are your expenses trending up or down? And how do the actual revenues expenses compare to the budgeted revenues and expenses? For your industry, do you know what percentages of your revenue should go to cost of labor? These are all just questions you should just double check in and just self-check yourself. So the sooner you catch a negative trend, the sooner you can adjust. And by understanding their industry and monitoring their financials carefully, lifestyle business owners can fine-tune their business to maximize profitability. So now I'm going to share with you the 6 important ratios, and this is still under the best practice number 4, that you can use to measure your performance of your company. It might get confusing. So again, if you go and get the LBO book, this is all very detailedly put out for you, and it's very helpful. So this is just like what I got from it. So I'm just gonna like read it off to you. Yeah, so number 1, return on the asset. So also known as ROA. So the first efficiency measure I will introduce to you is the most important one, and it's called return on assets, or ROA for short, and it's calculated as follows. I'm just going to read to you the calculation. So it's return on assets equals owner's discretionary income divided by total assets. Change that zone. So let's use an example. I'll use an example to demonstrate how the return on asset is used. So suppose my business makes $200,000 a year, meaning my ODI, or owner's discretionary income, is $200,000 a year, and my business requires $1,600,000 of assets, right, to generate. I don't speak Italian, I'm sorry. So yeah, so to generate this much profit, so my ROA would be $200,000 over $1,600,000. So, and this equals 12.5%. So let's say your business also makes $200,000 in ODI, but your business requires only $300,000 in assets. So your ROA would be $200,000 over $300,000, which is 66.7%. And no, I didn't just think of that on the top of my head. I'm reading this. So this means your business is a lot more efficient than ours is. So the ROA measures the overall efficiency of your company. So the higher it is, the more efficient your company is. And a high number is good and a low number is bad. And you want your ROA to be increasing over time. So every year you're looking back at it. So how do you increase your ROA over time? Do you ask? You have to understand what it is made of. So the ROA is made up of 2 components. It's profit and margin and asset turnover. So I'm going to explain both these 2 components really quick. So profit margin. So profit margin is the first component of ROA, and it's calculated as follows. Again, this a little equation. So it's profit margin equals ODI over total revenues. So if your ODI is $200,000 and your total revenues is $1 million, your profit would be $200,000 over $1 million divided by, which would be like 20%. So the profit margin tells you how much of your total revenues brings in, ends in the owner's pocket at the end of the day. So a high number is good, a low number is bad, and as a lifestyle business owner, I like to see the profit margin at like 15% or higher. It's always a good one. So asset turnover. Asset turnover is the second component of ROA, and it is calculated as follows. So it's asset turnover equals total revenues divided by your total assets. So the asset turnover measures how intensely you are employing your assets to generate revenues. A high number is good and a low number is bad again. So if your asset turnover is high, people call it a quick asset turnover. If your asset turnover is low, people call it a slow asset turnover. So I'm going to kind of explain to you how the profit margin and asset turnover are put together to give you your ROA. So you would do your profit margin, subtract it, I don't think that's the right way to say it, minus, okay, forget I said that. So profit margin minus the ODI divided by the total revenue. So of course you would do that first and then you'd subtract it. Thank you, great content. I'm trying to explain math right now. Now I know how teachers feel. Okay, so yeah, profit margin minus ODI over total revenues, and that would equal your asset turnover, right? And so then all of that would equal your total revenues over your total assets. So when you multiply those two together, you get the when you multiply these two ratios together, you get profit margin times your asset turnover, and that equals the ODI over total revenues times your total revenues over your total assets. And that equals your ODI over your total assets, which equals your ROA. Again, did I lose you? Probably I lost myself. So again, go over to the LBO book and get that book because it'll teach you how to do all this, and I'm just kind of giving you a little overview of it just because it's good to know and it's good to hear like kind of how confusing it is, and then when you go back and do it, you're like, oh no, this is easy. So as you can see, the total revenues cancel out and you get the ROA as a result. So in other words, the ROA is simply the profit margin and asset turnover multiplied together. So the higher your profit margin is, the higher your ROA is, and the higher your asset turnover is, the higher your ROA is. So if you want to increase your ROA, which is the overall efficiency of your company, you have to either increase your profit margin or increase your asset turnover. Math that matters. This is the math that they don't teach you in school, right? So usually your profit margin and asset turnover are negatively correlated. So what this means is if you want to pursue a high profit margin, you generally have to sacrifice a little on your asset turnover. And if you want to have a high asset turnover, then you generally have to sacrifice more on your profit margin. So I'm going to show you what I mean in a little example. So a doctor's office makes good profit margins because the doctor gets paid well to see other patients, but a doctor's office tends to have a low asset turnover because there is a limit to how many patients the doctor can see. Walmart, though, has really thin margins on its products. It makes only a few dollars here and there from the products it sells, but it has really high asset turnovers. So imagine the volume of the products that it sells. So the few dollars here and there start to accumulate, and this makes Walmart extremely more profitable than doctor's office. So both the doctor's office and Walmart are really efficient companies, and they're completely separate, obviously, in those, but meaning they both have high ROAs, but they are efficient in different ways. So if the doctor's office achieves its high ROA through pursuing a high profit margin, while Walmart achieves its high ROA through a high asset turnover. So you kind of have to think about like which strategy would you pursue? Should you aim for a high profit margin or a high asset turnover? It all depends on your business. So personally, on our businesses, we prefer to focus on the high profit margin. And as you know, we like to buy businesses in the service industry. So in our experience, it's much easier to get a high profit margin than it is to get a high asset turnover. But most owners of small businesses don't or charge their customers enough. So they think that if they charge more, they will lose customers. So the truth is that customers are willing to pay more if your customer service is good enough. And that's what we preach over here. So by providing excellent customer service and quality work, you'll be able to charge more, which will increase your profit margin. So once you achieve a great profit margin, then your work increases on its own. So yeah, that's a lot to think about. Hello, how are you? I'm great. How are you? I'm just, I love talking about being a lifestyle business owner. So number 4, a collections period. So your collections period measures the number of days it takes for your customers to pay you, and it tells you how good you are collecting money from people. And so let's say your accounts receivable policy gives customers 10 days to pay. Suppose we calculate your collections period and it turns out to be 22. That means on average your customer takes 22 days to pay you. How is my night? My night is great. I just finished watching Harry Potter. I've been binge watching all the Harry Potter, so I just finished the second to last one, so I got one more movie to go. It's been the best. Yeah, I love my Harry Potter marathon. So collections period. So suppose we calculate your collections period and it turns out to be 22. That means on average your customers take 22 days to pay you, right? So that's not good. Your collections period should be 10 or close to 10. And if your policy states that you give people 10 days to pay, then they should be paying. So here's how to calculate your collections period. And it's your collections period equals the accounts receivable divided by, and then you have your parentheses again, and it's total revenues over 365. So having the parentheses at the bottom means that you can calculate that part first, obviously, right? So you would divide your total revenues by 365 first, and then divide the results into accounts receivable. So the collections period is sometimes called day sales outstanding. your collection period should be close to 2 or less than your accounts receivable policy. So if you give people 10 days to pay you, your collections period should come close to 10 or be less than 10. So again, if you're just tuning in, yesterday we left off talking about the 5 best practices when it comes to financial management, and we only went over the first 3. So today we're going to finish it off with talking about the 4th and 5th best practices. So to review, the best practice number 1 was to keep meticulous books. Number 2, to learn and read financial statements. Number 3, create budgets every year. And then if you want to get yesterday's episode, head over to our YouTube channel or our Facebook page. So someone said, "You look beautiful. You look like you'd be nice." I'm nice sometimes, I guess. I'm always nice. Are you from USA? Yes, but I'm not in the US right now. So another question, should there be a difference between new clients and older clients? Example, newer clients, give them more time. Yeah, I think it also just too depends on your business and depends on your numbers individually. Like I think for our auto shop and our business that my parents do, I don't know much about it, but I know that they do give, like their customers that they are, for one, who come back like more often, they would give them more time. But then also too, if it was like, I guess newer customers, maybe. I think it just depends on you if you like would want, like depending how much you want that relationship with that customer, I guess, or just try to keep them within the 10-day period. Yeah, I mean, I think this is kind of, the 10-day period is just kind of like a guideline. But I think, I mean, if I like knew someone or, and I wanted to help someone out or whatnot, or if, like you could, it's always nice to give people a few extra days too, just because they feel like they can trust you and whatnot. But I think it just all depends like on you and your business. So yeah. Yes, exactly. As long as it builds a rapport with the client, definitely. I think that's the biggest issue, or not issue, but yeah, it's the biggest one to think about. So it's always about the clients, and it's all about your customer service again. So if you believe that that's it within your customer service and that's what you need to achieve, then that would definitely be something that you should think about, is extending that 10 days. So yeah, so okay, so we're still on best practice number 4, and we're talking about the 6 practices to measure your company's ratios. Again, that was a great question. Thanks for asking me. I'm speak fast. I'm from Brazil. Have you ever been here? No, I've never been from Brazil, but one of my best friends is Brazilian, and she was actually adopted from Brazil. So, yep. Okay, so number 5, days sales in cash. So days sales in cash is a measure of how much cash you keep in the bank accounts compared to how much sales you do, and it's calculated as follows. So it's days sales in cash, and that equals your cash divided by your total revenues over your divided by 365, again, those parentheses. So if this number's too high, it means you have too much cash in your bank account and the cash is not being put to efficient use. So therefore, you want this ratio to be low, but not too low. And if this number gets too low, it means that you don't have enough cash to cover your operations and your business might be in trouble. So what is considered high and what is considered low and what is considered too low? Well, that is going to vary with each business. I think all this sort of varies too, like with how, what kind of business you have, what industry you're in. So your business metric can help you determine the ideal amount of cash that you keep in your business bank account. So as long as your business is growing, you will keep more cash in the business bank account to ensure smooth operations. Quick ratio. So number 6, quick ratio. So the quick ratio measures your company's ability to meet its short-term obligations. So you basically compare your short-term assets with your short-term liabilities to see which one is greater. If your short-term assets are greater, that means your company is in good shape. But if your short-term assets are less than your short-term liabilities, you might be in trouble. So here's how the quick ratio is calculated. It's the quick ratio, and that equals cash plus accounts receivable, and that's divided by total current liabilities. Do you like how I do my divided by parentheses? So a quick ratio is 1.5 is excellent. So a quick ratio of 1 means you're doing okay. A quick ratio of less than 1 means you might be in some trouble. So the quick ratio tells you whether you have enough cash in accounts receivable, which can be converted into cash fairly quickly. So to pay the people that need to be paid. And last but not least, best practice number 5, don't buy anything you don't need to. So as you know, controlling your expenses is extremely important if you want to keep your company profitable, or companies. Are you spending the money in the right places? And how can you tell if you're wasting your money or if you're making good purchase decisions? So here's the principle. Every purchase decision has to make your business more profitable. A very common mistake that business owners make is buying too many pieces of equipment. So every time you're faced with a decision to buy or not to buy something, you have to ask yourself, do I absolutely need this right now? Can my business do without it? Is this something that is going to increase my revenues, and why? And I think that's just like in life. When if you don't need something, then yeah. If you don't need something, then you don't really need it. So it's kind of figure out your wants and your needs. That's what I'm saying. So as you know, there are 3 steps in the lifestyle business owner formula. Step 1 is to buy a good business. Step 2 is to increase its profits. And we have now covered the 4 ways to increase your profits. So smart marketing, effective employee management, smooth operations, and sound financial management. So to get more examples and see all the numbers and formulas on paper, please head over and grab the book, the LBO book, because you'll really enjoy it, and you won't just see me doing this and this on camera, and you'll actually be able to figure it out. So if you missed any part of this broadcast, be sure to subscribe to our YouTube channel so you can get a replay of this entire episode. If you are just joining us on Facebook, be sure to like our Facebook page. Again, my name is Sierra, and today we talked about Chapter 11, Part 2 of the LBO book, titled Improving the Bottom Line with Sound Financial Management. So be sure to check out our webpage and join the LBO Academy fam. And remember to subscribe and to join for free for the first 14 days. So it's free. You should do it. You might as well do it. So tune in tomorrow for our last broadcast for the week, and we will see you. Well, we'll see you tomorrow, and I will see you Monday. So have a good one.